You'll be house rich and cash poor. Retirement means monthly income, liquidity, flexibility. A paid-off house provides none of that. That sentence alone flips everything most people believe about money. There's a moment a lot of people dream about for decades. Sitting at the kitchen table, looking at that final mortgage statement, realizing the balance has hit zero. No more payments, no more debt, just ownership. It feels like winning. It feels like security. It feels like the smartest financial move possible. And that's exactly why it's so dangerous. Because what looks like safety on the surface is often the most fragile position to be in financially. Take a simple scenario. Someone drains their savings, maybe even pulls from an emergency fund or inheritance, and sends a final check to the bank. Mortgage gone. Celebration follows. Family congratulates. Social media posts go up. It feels like freedom. Fast forward a few months. Income disappears. Maybe layoffs hit. Maybe a business slows down. Suddenly there's no paycheck coming in. Now the situation looks very different. There's a house worth hundreds of thousands of dollars, completely owned, but there's no cash, no liquidity. Bills still exist. Groceries still need to be bought. Property taxes still show up. Life doesn't pause just because the mortgage is gone. And that's when the realization hits. Equity inside a house doesn't behave like money in a bank account. It can't be swiped. It can't be transferred instantly. It can't be used in an emergency without going through a process that depends on approval from institutions that are least willing to help when things go wrong. Banks don't lend money when someone needs it the most. They lend when everything looks stable. Strong income, clean credit, predictable situation. Lose the income, and suddenly that equity becomes locked. It's there on paper, but inaccessible in reality. That's the dead equity trap. Money that could have been flexible, growing, and available gets converted into something static, something that produces nothing, something that just sits there. It's like taking cash and sealing it inside a vault that only opens under perfect conditions. And here's the part that makes it worse. That equity isn't just sitting still. It's actually losing ground in real terms. If a house appreciates at around 3% per year, but inflation is running at 5%, the purchasing power of that equity is shrinking. On paper, the value is going up. In reality, it's buying less every year. So not only is the money trapped, it's quietly eroding. Now compare that to what happens if that same money stays liquid and invested. Instead of sending extra payments to the mortgage, imagine putting that same amount into investments earning around 8% annually. Take something as simple as $500 per month. Putting that toward a 4% mortgage saves about $68,000 in interest over time. That sounds good. It feels responsible. But that same $500 invested at 8% over 30 years grows to roughly $223,000. That's not a small difference. That's a completely different financial outcome. And it gets even more extreme over longer periods. Stretch that behavior over 30 years consistently, and the gap becomes massive. One path leads to a paid-off house worth maybe $700,000 to $800,000 depending on appreciation. The other path builds an investment account approaching $2 million. Same person, same income, same discipline. Just a different decision about where the money goes. That difference isn't just about numbers. It's about flexibility. It's about control. It's about options. Because the person with investments has something the paid-off homeowner doesn't. Liquidity. Liquidity is what allows someone to handle unexpected situations without panic. It's what provides breathing room. It's what turns financial stress into manageable inconvenience. Without liquidity, even a strong net worth can feel like a trap. That's why the idea of being debt-free, while emotionally appealing, often comes at a massive hidden cost. It removes leverage. Leverage is one of the most powerful tools in building wealth. It allows someone to control large assets while keeping their own capital working elsewhere. A mortgage, especially at a low fixed rate, is essentially cheap money locked in for decades. Paying it off early eliminates that advantage. Instead of letting money grow in higher return environments, it gets redirected into eliminating a low-cost liability. That's not optimization. That's surrendering potential. And the irony is that the house will still appreciate whether there's a mortgage or not. The presence of a loan doesn't stop the value from increasing. The asset behaves the same either way, so paying off the mortgage doesn't boost appreciation. It just changes where the money sits. Either it sits inside the walls earning nothing, or it sits in investments compounding over time. That's the real trade-off. And it's not just about growth, it's also about income. A $600,000 house that's fully paid off might feel like a huge milestone, but that asset produces zero monthly income. Now take that same $600,000 and invest it at 7%. That generates about $42,000 per year, roughly $3,500 per month. That's income, that's flexibility, that's the ability to cover expenses without touching the principal. A paid-off house doesn't do that. It provides shelter, but it doesn't generate cash flow. And retirement isn't funded by assets sitting still. It's funded by assets producing income. That's where the house-rich, cash-poor reality becomes unavoidable. On paper, everything looks solid. High net worth, no debt, valuable property. But day-to-day life depends on cash flow. Without it, even a strong balance sheet can feel restrictive. This is why the wealthy tend to think differently. They don't focus on being debt-free. They focus on being option-rich. Options come from liquidity, from access, from having multiple ways to respond to situations. Debt, when used strategically, becomes a tool instead of a burden. It allows capital to stay active instead of being locked away. And that's a fundamental shift in thinking. Because the real risk isn't owing money. The real risk is not having access to money. That's the difference between looking secure and actually being secure. And once that distinction becomes clear, the entire idea of rushing to pay off a mortgage starts to look very different. Now take that idea a step further. Picture two people with the exact same house, same value, same neighborhood, same everything. One has a fully paid off home and almost no cash. The other still has a mortgage but holds a large investment account on the side. From the outside, the first person looks more responsible. No debt, full ownership, clean balance sheet. But when life throws something unexpected, the difference becomes obvious almost immediately. The person with the paid-off house has no easy way to access money. Everything is locked. Every solution requires approval, time, paperwork, and perfect conditions. The person with the investment account has options. Assets can be sold, cash can be accessed, expenses can be covered without disruption. That's what real security looks like. Not the absence of debt, but the presence of flexibility. And this is where most people miscalculate risk. Debt feels risky because it's visible. There's a monthly payment, there's a number attached to it. But lack of liquidity is invisible until it becomes a problem. And when it becomes a problem, it's already too late. That's why redefining risk matters. Risk isn't about owing money. Risk is about not being able to respond when something changes. And something always changes. Jobs aren't guaranteed. Markets shift. Health issues happen. Expenses show up uninvited. In those moments, access to money matters more than anything else. Now bring inflation into the picture, because this is where things get even more interesting. A fixed-rate mortgage locks in a payment in today's dollars. Over time, inflation reduces the value of those dollars. So that same $2,000 monthly payment that feels heavy today becomes lighter and lighter in real terms as years pass. Income tends to rise over time. Prices increase. But that mortgage payment stays fixed, which means the burden decreases. In simple terms, the debt becomes cheaper. That's one of the biggest hidden advantages of long-term fixed debt. And paying it off early destroys that advantage. Instead of letting inflation erode the value of the debt, the balance gets eliminated using today's stronger dollars. That's like choosing to pay full price today instead of letting time apply a discount. And that discount compounds over decades. Meanwhile, money that could have been invested loses the chance to grow. That's the opportunity cost most people never see. It doesn't show up as a bill. It doesn't feel like a loss. But it's there. Every extra dollar sent to the mortgage is a dollar that stops working. It stops compounding. It stops generating returns. It stops building future income. And over long periods, that cost becomes enormous. That's how the gap between a few $100,000 and a couple million gets created. Not through dramatic decisions, but through consistent small choices. Now consider behavior. There's a common belief that once the house is paid off, all that extra money will start going into investments. But that's rarely what happens. When the mortgage disappears, lifestyle tends to expand. Better vacations, new purchases, upgrades that were delayed before. The money gets absorbed. it doesn't automatically get redirected into wealth building. Keeping the mortgage in place creates structure. It forces discipline. It keeps financial habits consistent. And that structure often leads to better long-term outcomes. There's also something else most people never think about. A fully paid off home can actually make someone more vulnerable in certain situations. With 100% equity, that asset becomes a clear target in legal disputes or claims. When a large portion of a home is financed, there's less equity exposed. It changes how the balance sheet looks from the outside. And while that might not matter day to day, it's part of the bigger picture of financial strategy. Now zoom out and look at the bigger pattern. The people who build significant wealth rarely rush to eliminate low-interest debt. They focus on maximizing returns, maintaining liquidity, and preserving optionality. They use debt strategically. They understand that money has different roles. Some money is meant to grow, some is meant to provide stability, some is meant to create opportunities. Locking large amounts into home equity removes those roles entirely. It turns dynamic capital into static value, and static value doesn't adapt. That's the core issue. Because financial life isn't static, it's constantly shifting, and the ability to adapt often matters more than the initial position. That's why being option-rich matters more than being debt-free. Options mean choices. Choices mean control. Control is what allows someone to navigate uncertainty without being forced into bad decisions. Now bring everything together. A paid-off house provides emotional comfort, but financially, it removes leverage, eliminates liquidity, and creates massive opportunity cost. It turns a flexible system into a rigid one, and rigidity is fragile. On the other hand, maintaining a mortgage while building investments creates a system that can absorb shocks, generate income, and adapt over time. It may feel less comfortable at first, but it's significantly more resilient. That's the difference between appearance and reality, between feeling safe and actually being safe. And once that difference becomes clear, the strategy becomes obvious. Stop treating debt like the enemy in every situation. Start evaluating what that debt is actually costing versus what capital could be earning elsewhere. Look at the spread. Look at the flexibility. Look at the long-term impact. Because the goal isn't just to eliminate payments. The goal is to build a system that supports life no matter what direction it takes. And that system requires liquidity, growth, and optionality, not just ownership. Because at the end of the day, a house can provide shelter, but it can't provide income, flexibility, or financial freedom on its own. That comes from how capital is deployed and where it's allowed to grow. If this perspective shifts the way money decisions are being viewed, then the next step is simple. Take a look at any extra payments currently being sent toward a mortgage and reconsider where that money could work harder. Think about what consistent investing over decades could build instead. And most importantly, focus on building liquidity alongside long-term growth. Because that combination is what creates real financial security. If this changed the way a paid-off home is viewed, share it with someone who believes being debt-free automatically means being safe, and subscribe for more breakdowns that challenge the way money is usually understood.